Trump's 90-day pause on imposing additional tariffs makes a rare moment of restraint, widely seen as a reaction to mounting pressure from the Wall Street and major financial institutions. His unpredictable approach to trade, particularly the escalating tariff war with China, had begun to unsettle global markets, threatening to tip the world economy into a deeper uncertainty. By pressing pause, Trump effectively blinked in the face of economic reality. He may have expected the markets to respond dramatically to his aggressive posture, with stocks diving and bond yields sinking in a flight to safety, thereby reinforcing his narrative of leverage. But the markets dropped and the bond yield went up. In fact, in the first few days of the market meltdown, Trump seemed to be getting his way. By April 4, the 10-year Treasury yield had dropped to 3.86, and a giant drop from the 4.4 level towards the end of March. As Fortune reports, that scenario was short-lived. 10-year Treasury yields went on a seldom witnessed tear starting on April 5, surging over 600 basis points to 4.5% by the morning of April 9. The news for companies mirrored the downer for consumers. Credit spreads on investment-grade corporate bonds jumped by just under 1% to 1.2% in early April, and the premium on high-yield offerings expanded by 25% from 347 to 461 basis points. Why did the yield spike so much? Well, because the tariff jolt freaked the investors across the board. Future quotes Arnott of Research Affiliates, who is particularly concerned about China's potential power in American financial markets, courtesy of his huge holdings of US treasuries. And I quote him, "If they are big sellers, bond prices will tank and yields, which move inversely to prices, will spike, a sure way to get under Trump's skin." And I quote him, "I think the Chinese government has read The Art of War, which has been Trump's Bible for life." Gosh, you don't think someone would want to play that card, do you? Apollo Global's management's chief economist, Torsten Slok, had told the Fortune in September last year that the US debt, now at 35.3 trillion, the cost of paying the interest on all that borrowing has soared recently and now averages out to $3 billion a day. Yes, $3 billion a day. The daily interest expenses has doubled since 2020 and is up from $2 billion about 2 years ago. That's when the Federal Reserve began its campaign of aggressive rate hikes to rein in inflation. In the process, it made the servicing US debt more costly as Treasury bonds paid out higher yields. If the Fed cuts interest rates by 1 percentage point and the entire yield curve declines by 1 percentage point, then daily interest expenses decline from $3 billion per day to $2.5 billion per day, Slok had estimated back then. Trump was banking on this, but the yield went up. The episode underlines a crucial point. While political leaders may attempt to shape market sentiment, global financial systems are often guided more by fundamentals, long-term stability, and investor rationality than short-term political theatrics. Wall Street's pushback wasn't just about profits. It was a warning that erratic trade wars could unravel decades of economic integration. In this case, the market called the bluff, and Trump had little choice but to recalibrate. For ThePrint, this is Snehesh Alex Philip.